All right, founders, welcome back. We are here for the final segment of episode number 7, which is all about tax tips to navigating our tax return, along with the 2020 COVID benefits that we received last year. So this segment, Brian Quinlan is back with us, chartered accountant, and he is going to be sharing with us some ideas and strategies that once we get through April, how we can better prepare ourselves and really kind of take ownership of our taxes throughout the year so that it's smooth sailing come this time next year. All right, Brian, what are your thoughts on this topic?
Okay, it's a good point. We obviously see lots of clients over the next couple of months for tax returns for 2020, and they say, what can you do to minimize my tax bill? And sadly, the answer is it's too late. To be honest, you can't restructure a corporation going backwards, and you can't restructure a person's flow of income and stuff like that. So the big is always looking forward, is what can you do, as you said earlier, in 2021 to decrease your tax bite going forward, kind of thing. There is some things we can do on 2020 returns with pension splitting and things like that, but the majority of your tax savings, whether you're just an individual person or you're a sole proprietor or you're an incorporated business, will always come going forward. What can you do now, kind of thing. So the tax return you filed may have just been fine, like you did nothing wrong, nothing illegal or things like that, but could there be a better way to restructure your affairs, again legally, to minimize your tax bite plus your family's tax bite? I always say don't be a selfish tax return person, taxpayer. Spread the wealth amongst family members as you can. There's been some rules that kind of cut this down, but we'd hate to have one spouse have a $200,000 income and the other spouse having a zero income. The tax bill for that family could be better if they were both at even numbers, kind of thing. But again, there's been rules or new tax incentives, tax decentives, I guess, to do that. But there's still a lot of rules that can be taken advantage of to minimize you and your family's tax bite going forward.
Okay. So how do we take advantage then? What should we be asking our accountant, or, how do we start that process?
Well, again, the accountant should be telling you.
Okay. And if
what
they're
you
not?
should do. If you're not, then, well, again, we always say, why aren't they, kind of thing. So
okay.
There's many tax preparation services, like if you go, and they're designed to prepare your taxes, and that's fine. That's what you're paying for. But an accountant should be preparing your taxes and also looking forward to restructuring your structure of your money or your family, again, if he or she can, kind of thing. So the question you want to ask or have them ask you is, what can you do to minimize your tax bite next year going forward? Let's say your income was exactly the same 2020 or 2021, it's going to be the same, ignoring any COVID stuff, kind of thing. What can you do? And again, the idea is there any chance of income splitting? Again, shifting income away from you, perhaps to a spouse or to a child, or the use of a family trust. Would that be of use to you? There's obviously costs in setting up a family trust or something like that. But again, the question always is, that's a great idea. Will the benefits outweigh the costs? And if they do, then maybe you should look at that, kind of thing.
Okay. Okay. So here's how my mind is interpreting your words. Okay. I'm hearing, have an accountant that probably understands both your personal situation as well as your business situation.
Right. You can't really separate them. You can't separate them. So
okay. Although two separate returns, right? But yeah, we're not having separate accounts.
Two separate entities. That's right. You can't.
Right.
But really, in terms of planning and the way our Income Tax Act works, is you can't separate.
Okay.
Because the business has to pay the entrepreneur, whether it's paid through salary or paid through dividends, right? So it's
right.
Two entities, but you can't separate.
Right. So you can't. We're not splitting it up. They're separate. And I just want to clarify that for a lot of founders that are listening, because I know already a lot of founders have a hard time personally separating business expenses from personal expenses, especially if they're self-employed, right? It's like they're using one credit card for everything. But what we're suggesting here is one accountant that knows both what's happening on the business side, knows what's happening on the personal side, and has your best interests with respect to how to mitigate your taxes and be able to take some of those tax dollars and have them potentially reinvested to make sure your overall financial goal is being met, right?
That's exactly right. So
sitting down with your accountant and asking how to mitigate taxes, both on a corporate side, on the corporate side, as well as on the personal side,
right? Okay.
and how those two tie together.
Exactly, how to structure. So let's say you do have a corporation. Simple, are you being paid a salary? And okay, the first answer would be if you're in business and you have a corporation. In terms of tax rates, the answer would be don't pay yourself a salary, don't pay yourself a dividend. But practically, you probably have to buy groceries, right? So you have to pay yourself something. Should that be a salary? Should that be a dividend? Should it be a combination of both? And how much? Okay, because probably the corporate tax rate is lower than your personal tax rate. So we want you to live on as little as possible. The money is always there though. It's not like, but that would be the general plan. Perhaps you have a spouse that's working and he or she can fund your family's living expenses. So I'd want more money to stay inside the corporation versus outside the corporation because of the lower tax rate in the corporation.
Okay. So I'm curious, if I love to see scenarios. I love to see when I'm speaking to an accountant or a lawyer, you know, the accountant I see is about mitigating my taxes. The accountant I see is about mitigating my risk. I love to see, okay, show me what happens with the numbers in scenario A, scenario B, scenario C, and then, you know, give me an understanding of the costs and consequences. And then let me make that decision. Is that tedious for an accountant? Do accountants hate it? Because that's a lot of calculation. Or do you have all the templates and spreadsheets? So it's like, if we did this, this is what it looks like. If we did this, this is what it looks like.
We have all the templates. Yeah, this is what we do. We do it all the time. So
easy to ask.
And we're always thinking. We're always thinking. As I said, I can't make you money. I can let you keep your money. That's what my role is to do. I can't make you $1, but I'll let you keep 50 cents of that, or maybe I'll do better and let you keep 80 cents of that. Then you'll be really happy, that kind of thing. And I can do that. So that's exactly what we do. We look at the very, very, very bottom line. You can't go any lower than us, kind of thing. So, but that's exactly what accountants do, and that's how we'd explain it. If you go this route, you're gonna save 80 cents on the dollar. If you go this route, it's gonna cost you 50 cents on the dollar.
Okay.
So if you, that's what we do.
Well, that's a great soundbite. I like it. I can't make you money, but I can save you money. I can help you keep your money. So
yeah, that's
we're
exactly
gonna be using that one.
Okay.
All right.
I'm sure I stole it. So
okay. Anonymous. All right. Would you mind walking us through? I get asked this all the time from founders and employees alike, but the differences between a TFSA, a tax-free savings account, and the RRSP.
Yes. Okay.
Because we're at this time now where they're going to be hearing or seeing a lot of messages that are like, you get to top up your RRSPs this year. You've got until, I don't even know when the deadline is. Walk us through the difference between both and what we just need to be aware of before we rush to put everything into an RRSP, whatever we have, if we have something to put in.
Right. Well, the RSP deadline, if you want a deduction on your 2020 return, there's that 60-day extra window. So you have until the end of February. I think the deadline's really March 1st. So you can run to your investment advisor and give he or she some money and get a deduction on your 2020 return if you have the contribution room, kind of thing. So the RSP, the answer, should I have an RSP maxed out and a TFSA maxed out? The best answer is yes to both. All right, but that's a lot of money, perhaps, right? And then, so people say, I don't have that much money. Okay, so then I would probably say, well, when do you need this money? So if someone is 20 years old and looking at perhaps getting married or paying for a marriage or buying a car, or they're going to need the money in the short term, I lean more towards the TFSA, because as the name, it's an S. It's a tax-free savings account. So it's not designed perhaps to wait all the way to retirement, but it can be. But so I think if younger people I would deal with, I think it's been more attractive to the younger generation, is they put money in, they don't get a deduction for it. With an RSP, if you put money into your RSP, you get a tax deduction for it. So if you put money into a TFSA, there is no tax deduction for it. The money does grow tax-free as it does in an RSP, but when you collapse the TFSA, the money comes out all tax-free. So there's no tax at all, no tax deduction, no taxable income. With the RSP though, you take your money out, it's taxed. So you get a tax deduction going in, but you get a tax coming out, kind of thing. So that's it. So if you think you're going to need the money, so I'm looking at younger people, like perhaps buying a car, putting a down payment on a house, then the TFSA would be the bigger one. So
because it's also about the fees attached to taking out, right? If you touch your RRSPs, you're going to get
Well, it's tax, not so much the fee. It's just that you're
Okay.
gonna have to pay a tax bill kind
The
of thing.
tax, okay.
And you've lost that RSP contribution room forever. So with the TFSA, if you take money out, your contribution room regenerates. So if you put $6,000 in today, as we all
Yeah.
could, and you took it out, that $6,000 will add to your contribution limit next year. So
Next
you have to wait
year.
to the end of the year. Okay, so
Yes.
that's it. So with RSP, you take money out, it doesn't regenerate the contribution room. So you just lost
Okay.
that contribution room. So if you think you're going to need the money, I lean more towards the TFSA. But if you're more really looking for an extra retirement, fund your RSP first, and then fund the TFSA, and never touch it until you retire.
Okay. Well, and so you brought up a really important point, because I know several clients of mine actually had a unfortunate consequence of then topping up their TSFA. They took money out and then they went to put it back in, and they failed to understand that it had to go in the year after, right? Putting it in that same year put them over what that contribution limit was.
Exactly. That's been a problem since day one of the TFSAs, and also the difficulty if you deal with more than one institution. Say you have a bank.
Yes.
TFSA, and you also may have you meet an investment advisor. It says give me your TFSA money, and they're not talking. No one's really know if you've contributed or not. So suddenly you've made two contributions, and you're over, kind of thing. So that's been tough. And then you will get a bill that both an RSP over contribution and a TFSA contribution. The penalty is expensive. It's 1% per month, so that's 12% per year of what the penalty is. So you really don't want to go offside that. The good news is the government's been a bit taxpayer friendly, if you want to call it that, with TFSA over contributions. If you really did make a mistake, you can ask for them to be really say, I'm sorry, I made a mistake. Can you forgive this penalty? And they often will.
First time.
First time. Yeah, I wouldn't go 2 or 3 times with it, but they will. So that's been one thing. With an RSP, if you go over, there's no relief kind of thing. So that's because the TFSA is the new kid on the block. New being, I think it's 10 years old now, but it's still the newest investment vehicle we have, registered plan.
Okay. And so again, so I'm thinking in my world, as I would approach the accountant, I would probably want to see the scenarios. I would want to understand if I have extra money and I'm looking to invest it. I would want to understand what my taxable income was for 2020. Yes. I would want to understand that, if I'm over a specific bracket, whatever bracket I'm in, if I took that out and put that into an RSP, what impact would that have on my tax dollars, or what impact would that have on my return? And just kind of calculate that math to see if it would make sense to actually put that money, if I'm in a low income year, if it would make sense to put that money in an RRSP.
Yes.
Or would the savings on the capital gains in a TSFA actually outweigh the savings on my taxes for this specific year?
Yeah.
It's cloudy.
You're right.
I know people are trying to follow this ball back and forth, but yeah.
No, but if you don't, I'll lead to that is many people's income for 2020 because of COVID may be low.
Yes.
But let's say it's gotten better in December and now it's better now. I'd still want them to maximize the RSP, but we don't have to take a deduction for it. We can save that deduction for another year. So if you had a low income year, especially if you're starting out force, or because of COVID, your income has been quite low, or you took a year off, say you're on mat leave or something like that, then I still want you to fund your RSP, but you don't have to take a deduction for it. You can save that deduction for a future year when your taxable income is higher and your tax rate is higher.
Gotcha.
So meanwhile, the money's growing inside your RSP tax-free. That's a good thing. But the deduction, you're not handcuffed to take the deduction in the year. So even if you contribute now, like today, you don't have to take a deduction in 2020 or 2021. Let's say you're going to have really high income in 2022 or 2023. When your kids are at school and you're finished mat leave, I'll take the deduction in those years and get a better bang for your buck in terms of the tax relief.
I didn't know that. So thank you.
That's the kind of thing. Yes, make maximum RSP contribution, but perhaps not deduct it right away.
Okay.
Save it.
Brilliant. And so the last question in this segment, I'm curious, because I think a lot of founders are going to find themselves probably saddled with a considerable amount of debt from 2020, whatever that might look like. Maybe people have remortgaged homes, tapped out credit cards, lines of credit, and now their tax bill is going to come due. Maybe they owe something, maybe they don't, but now we're going to have another debt that's on there.
Another debt, it could be credit card debt or a line of credit debt at your bank, or
Right,
yes, okay.
right. So what feedback do you have as an accountant when you're speaking to your clients around how do you prioritize what debt to get paid first?
Well, the first one is there's good debt and bad debt, of course. So if you've had, if you borrowed for your business, then that interest should be tax deductible. So if you went out to the bank during the COVID benefits, I need $50,000 to buy a new machine, or I need $50,000 to cover my rent for the next 4 years or next 4 months, that interest will be deductible because you're borrowing to earn business income. So that's what I call good debt. But let's say you borrow to go on a vacation, or you borrow to pay off your mortgage, your personal mortgage, that interest isn't tax deductible. So I'd want that to be paid off first. So look at what's good interest and what's bad interest first, ignoring
Okay.
rates and things like generally ignoring rates. And I
Okay.
want your personal debts taken care of first because that interest is not tax deductible. So that personal credit
Okay.
card, if it hasn't been used to fund a business, should be paid off first.
If the personal credit card has been used though to fund the business, and you can prove that through the line items on the credit card,
Yep,
that
yep.
interest attached to those expenses
It would be tax
it would
deductible.
be
That's
tax
right.
deductible. Okay.
Exactly. And that's where I
Okay.
really focus on trying to really keep your, as you mentioned, your personal and your corporate affairs separate. So I'd
Okay.
want your loans to be, if we can have the paperwork, because one thing CRA often looks at is interest deductibility. They're going to say, prove it.
Yeah.
And if you start getting credit cards and saying, well, this was personal, but this was business and this was personal, it just gets, it's messy and more tough to defend and things like that.
Yeah.
So
Numbersome.
Numbersome, and no one believes you. Okay, and then so if you can keep, so look at personal interest, getting that paid off first. And if it's, let's say you have no personal debt, that's great. Then interest is tax deductible. People say, well, why bother paying it off? Well, you're still out of pocket money, even after the tax savings is you're out of pocket. So I look at the highest interest rate first. Okay.
Okay.
We talked about CRA's interest rates, which may be lower than your credit cards, but it's nice to get rid of CRA, not getting those hate mails every month,
Right.
telling you. But anyway, if you're paying credit card interest at 21, 22%, I'd want you to knock those down.
Right.
So.
Especially if people missed payments last year, right? You know, as soon as you start missing payments, they edge the interest rate up higher, right?
It does. There's penalties if you get into a couple of years of being behind in taxes, then there's interest rates that are penalizing interest rates. So it goes up. So you've got to balance.
Okay.
And no one really likes CRA calling. Collections will call. This last year, they've been quite generous with COVID in terms of calling. But as we kind of come out of COVID here, I can see collections and assessing getting back on the horse and things like that. Yes. Okay.
And can you just clarify? I know that, you know, there's always discussion around the power that CRA has to seize accounts, to stop operations, right? To be able to collect what it is that they need to collect.
Yes.
Do you have any feedback on that? Is there anything like, should we be scared? Should we not? Like at what point do they actually start seizing accounts?
CRA, I would think is if you owe money on April 30th and don't pay by May 1st, you're not going to lose your house right away. But I would take the debt seriously. So they do have the powers of perhaps not taking your house, but freezing your bank accounts to make you sell the house to pay off. That's an extreme. Like that's after many years and many letters and many. The best deal is if you really do have a debt to CRA you can't take care of, is work out a deal with them. Say, I will pay $1,000 a month for the next 4 years and stick with it. And then CRA will leave you alone as long as you stick with your debt kind of thing. So
I think, sorry, Brian,
and then if it really is really unbearable, then there's people you can talk to that know about making proposals to all your creditors and things like that.
Right, right.
So that's a next step kind of thing.
Yeah, and we've run a couple of episodes with those discussions. So if founders, you're listening to this or watching this and you're curious, just go back to, you know, I believe it's episodes 4 and 5 where we start talking about debt and some of your options there. But thank you for that, Brian. I think that gives people a little bit of peace of mind. You know, as past pros have said too, do not go into dark mode, do not go into silence mode, communicate, let them know what's happening. And even just small chunks of money, if you can, it's like, you know, to your point, is it lets them know you're doing the best that you can with the tools that you have, right? We've been through a year like unlike any other out there.
Yes. Okay.
So, Brian, thank you. Anything that you want to add? We covered a lot of ground today. I so appreciate your time and your insight.
Okay. The best things I think to jump in are to be organized in terms of the tax season coming up with this, and looking forward, what can you do to change your structure, especially if you have corporations and you're an entrepreneur. What can you do to make sure you're taking advantage of all the current income tax incentives? Again, nothing fraudulent, nothing aggressive. There's just tried, tested, and true, black and white tax planning things that there could be very easily put in place, kind of thing.
Perfect. That just speaks to your point that you said the only way to save taxes is in going forward. There's nothing that you can do when you've already spent the money.
Very little, yes. Okay.
When you get this done, your 2020 is done and filed. Now that is the time to sit down with your accountant and say, okay, now what can we do going forward? What do we need to adjust
exactly
this time next year? Okay. Mm-hmm. Well, Brian, thank you. I believe that you said that you're available for founders to contact you, correct?
Sure. Okay.
You are in the province of Ontario, so making that clear. Brian's contact information is in the show notes below. Again, just feel free, please download the free playbook and the tools that are available with this segment. And just a big shout out to our champion again for this episode, Community Futures of Manitoba. They have been instrumental in helping business owners across that province, but Community Futures runs the gamut coast to coast. And so if you are in a rural community, make sure to reach out to your CF office. They're there to support you and walk you through this. All right, that is it for me. Thank you so much, Brian, for joining.
You're very welcome. It's fun. Okay.
The founders listening, stay strong, stay safe, and stay financially fierce, and you've got this tax return done. Good job, everybody. Okay, we'll see you for the next episode of the Gab Lab.